there a clicker or just you?
It's just this.
Just that.
It's just this. Yeah, because I think this is all they have. Yeah. So you can speak right in there. You got a few ways you can do it. I think you can either advance it or you can take and just roll it.
Yep, just like
Maybe fine.
Thank you. Good afternoon. Is everyone ready? Had lunch? I'm going to make everyone stand up and do a few jumping jacks before I start. I'm just kidding. My name is Sarah Howe. I am happy to be here today. I am an employee at the Duke HR Center over on Broad Street. And I'm also have the pleasure of having 4 Fidelity representatives here with us today. As I present, you are welcome to ask questions, general in nature, that I can answer for you. And if I cannot answer, I may be able to ask you to stop outside after we're done, and we can certainly talk more privately at that time. But again, my name is Sarah Howe. I'm going to go ahead and get us started today. So today we're going to talk about the 2 retirement plans that Duke offers. The Employees Retirement Plan, known as the ERP plan. We're going to talk about what it is, when you can access your pension plan. And we're going to talk about the Duke 403B plan, known as the Faculty and Staff Retirement Plan. What is the Faculty and Staff Retirement Plan, and why should you participate? So financial experts do say that you will need about 75% of your pre-retirement income in your retirement. That could consist of your contributions to retirement plans, Duke's contributions to retirement plans, Social Security, and I'd like to name a few others if you're fortunate to have an inheritance or other sources of income from other past jobs. All of those sources of income could be very important in your retirement. And when you look at a 3-legged stool, you often think about, well, if I don't have one of those legs, what would happen? The stool would fall. So we like to think about having a good, stable income sources in your retirement, so you will not be in a situation where you won't be able to enjoy your retirement. And I like to say it might endanger my shopping trips to Belk, so I definitely want to make sure I am considering all sources of income so I can plan accordingly. So your retirement plans at Duke, employees paid biweekly are able to participate in the 403B plan, that's the Faculty and Staff Retirement Plan, and Duke you're automatically enrolled in the defined benefit plan known as the Employees Retirement Plan. That is the Employees Retirement Pension Plan with Duke. Employees paid monthly are able to participate in the 403B Retirement Plan, the Faculty and Staff Retirement Plan, and Duke will make a contribution to the Faculty and Staff Retirement Plan as well. So let's talk about the 2 plans. Also, there are many times that we see that employees have transferred from one payroll to another at Duke, from biweekly to monthly or monthly to biweekly. You may be entitled to a benefit under the Employees Retirement Plan, that's the ERP plan, for employees who are paid biweekly. If you are entitled to a benefit, that benefit is frozen and calculated using your years of service and compensation for the time that you were paid biweekly. And each year when we send out the annual benefit statement, that frozen piece will be included in your benefit statement. We just sent those out recently. How many recall receiving one? Excellent, excellent. They're very helpful. It is nice to see a nice summary and a lot of information in one place. So those are sent out each year at the beginning of May. What is the Employees Retirement Plan, the ERP plan? First, the way I think about the pension plan with Duke is the benefit is defined. That means that Duke makes all of the contributions. You are not required to make any contributions to the plan, and you may supplement your retirement savings through the Duke Faculty and Staff Retirement Plan. It's the 403B plan that allows you to make voluntary contributions as well. For eligibility, you automatically become a member if you have reached age 21 and have worked at least 1,000 hours during your first year of employment or in any future fiscal year. A fiscal year is from July 1st to June 30th. Vesting, you will be 100% vested in the ERP plan upon completion of 5 years of continuous service, attainment of age 65 while employed by Duke, hired after age 65. And I see a lot of people often stay working at Duke after age 65, so that is not unusual. So as I said, the Duke pension plan is based on a formula. The formula is 1.25% of average final compensation times years of credited service up to 20 years, plus 1.66% of average final compensation times years of credited service for any service over 20 years. The calculation also takes into consideration your average earnings, that's the 5 highest consecutive years of the last 10 fiscal years, your age and years of credited service. So when can I start to receive a benefit? The plan defines the normal retirement as age 65 to receive a full benefit. That's a full unreduced benefit. You can start an early retirement if you retire from Duke at least at age 45 or older and have 15 years of credited service. But that is reduced based on age at time the benefit starts. And think of it this way, it's because the benefit is being paid out over a longer period of time, so the benefit is reduced accordingly. If you work past age 65, you can take a deferred retirement. That's working at Duke past age 65, and you are eligible for additional 10% for extra credit service for the time over age 65. What are my payment options? The plan offers a single life annuity that is a monthly benefit payable each month for your lifetime, and if you pass away, the benefit stops. The benefits are also payable in a joint and survivor annuity. That's 50%, 75%, or 100%. So that is a benefit payable to you and a beneficiary. So the benefit is divided over 2 individual lifetimes. The employee begins receiving their benefit, and if the employee passes away, the beneficiary then starts receiving either 50% of what the employee was receiving, 75% of what the employee was receiving, or 100% of what the employee was receiving. So that will be a choice you'll be able to make if you have a beneficiary. Now, if the beneficiary passes away first, the benefit does not change. The payments continue to the employee until the employee passes away, and then it stops. The next payment option is called a level income age 62 or 65. And the strategy of this particular payment option is really designed for you to, allows you to pick a payment option that pays you a higher amount prior to reaching age either 62, or if you select age 65, that benefit is payable at a higher amount until you reach that age, in anticipation that that is when you would level your income at Social Security age. So that becomes level if you start Social Security. If the lump sum value of your benefit is less than $10,000, you may be eligible for a lump sum payment. and that is determined at the time you retire from Duke. Usually we see that only in cases where someone was perhaps biweekly for a very short time. If the value of the benefit is determined to be higher than $10,000, then there's no lump sum payment option available. Payments under the employee's retirement plan are considered taxable income. And if you pick a payment option and you select a beneficiary with a very young age, perhaps like a child, in a situation like that, you are likely to see your payment option reduce substantially to account for the likelihood that that child would be in receipt of a benefit if you should pass away. And you can imagine a child is likely to live for many, many more years. So again, a beneficiary, just an example of a child, would then start receiving that benefit at a young age and then receive that benefit for life. So that could really impact your payment option if you do select a beneficiary at a big age difference. You can run an estimate of your pension through the employee self-service tool. It allows you to generate the estimate of your benefit at any time. You can access that through Duke at Work. It also gives you an opportunity to review retirement planning resources. There are tons of information available. You can review the rules for the employee's retirement plan and the faculty and staff retirement plan, Duke retiree health information, and a very important document that's used by our group is the Duke Retirement Planning Guide. It's a wonderful resource to help you start planning when you're getting closer to retirement, and gives you a nice timeline as well as information and a checklist. There's links in the tool to, in particular, to the Social Security website. And you can review your personal information, date of hire information, home address information, the last 10 fiscal years of compensation, and it's updated after every pay period. So it's a wonderful resource. I highly encourage you to take an opportunity to look there if you haven't already. So we encourage that a lot. We're going to transition to the discussing the Duke faculty and staff retirement plan. Is there anyone that has a question that lingered regarding the Duke pension plan? No? Oh, go ahead.
I was trying to look the pension plan up on the HR website, and it seemed like there wasn't a lot of information available beyond just the link to estimating your pension payout.
Okay.
Is all that information in a policy, or is there somewhere to find information that you have on the slide?
That's a great question. So the question is that employee would like to find information specific to the Duke pension plan and what available resources there might be available for you to find. It might be helpful in navigating through with someone. You can stop by our office or call at any time. They have a lot of summary plan documents available. It's out there. But if you're ever interested in coming by just to talk with someone, you can do that, or give us a call, and we may be able to point you directly to that resource. Great. Okay. So next I'm going to talk about the faculty and staff retirement plan. It's also known as the 403B plan. Many of you might be familiar with a 401k plan that you might have had from a former employee. It's very similar to a 403B plan. All employees paid monthly and biweekly can participate with your contributions from your paycheck into this plan, the faculty and staff retirement plan. So in general, salaried employees paid monthly are eligible for a Duke contribution after completing 1 year of service and reaching age 21. However, vesting rules do apply. If you are eligible for Duke's contribution, you may be eligible as a new employee to waive the 1 year wait. And more information is available online at hr.duke.edu/service waiver. And you can enroll anytime through Duke at Work and the self-service tool. This slide illustrates the Duke contribution formula that's eligible employees paid monthly. 2019, the formula is 8.9% of the first $64,750 of salary and 13.2% of annual salary in excess of $64,750, up to a statutory salary limit of $280,000. Now, at the bottom, there's an example with an employee earning a $69,000 annual salary with a monthly salary of $5,750. So the first part of the contribution that Duke will make is 8.9% multiplied by this monthly salary of $64,750. That equals an annualized Duke contribution of $5,763. The second piece is that Duke will apply 13.2% of the remaining amount of $4,250, and that would add up to a total annual Duke contribution of $561 for that portion. So then you add the two together for the total in 2019 for the annual salary of $69,000 to equal a total annual contribution of $6,324. For vesting, employees hired before January 1st, 2012, you are 100% vested in both employee voluntary contributions and the Duke contribution. And if you are subsequently rehired by Duke, you will continue to be 100% vested. Employees hired on January 1st, 2012 or thereafter, you are 100% vested in your employee voluntary contributions, and you will be 100% vested in the Duke contribution upon completing 3 years of service, attainment of age 65 while employed by Duke, hired after age 65, death while employed by Duke, or approved for long-term disability under the Duke long-term disability plan. So why should you participate in the faculty and staff retirement plan? Well, first, this plan allows you to control how much you save for retirement. A little saved today can mean a lot in retirement. Duke offers you access to quality investment options, and you have the ability to roll over funds from a previous employer into the plan. So you have some decisions to make. First, how much, perhaps which funds, and other factors, maybe personal factors that might enter into the picture. But you need to make some decisions, but there are resources available to help you. So how much are you going to contribute? You can contribute a flat dollar amount or a percent of pay on a pre-tax basis, Roth after-tax basis, or a combination of both. The minimum contribution amount is 1% of pay. So even if you're just getting started or you just think, well, I just really can't do all that much, think about 1%. You can do a minimum of 1% just to get started. You won't even notice. The maximum contribution is 80% per pay period, or up to the IRS limit, that's $19,000 for 2019, and it's $25,000 for employees over age 50. There is a take-home pay calculator. I think you can access that through your Duke at Work. The website address is here. It's on this slide, but you can also access it, I believe, on your Duke at Work. So, pre-tax contributions versus Roth after-tax contributions. Duke offers you the ability to consider contributing pre-tax or after-tax through the Duke retirement plan. Through this plan, the contributions, the difference is, in this particular grid, the pre-tax contributions are deducted from pre-tax pay. The Roth after-tax contributions are deducted from after-tax pay. Investment earnings are taxed at withdrawal under the pre-tax contributions, and investment earnings are tax-free at withdrawal if qualifying conditions are met. And basically that means that you may make tax-free withdrawals of your contributions and any earnings provided you are at least age 59 and a half and made your first Roth contribution at least 5 years earlier. And the clock starts ticking that when you make that first contribution, the year you make it. So if you started making a Roth contribution in November, that counts as the first full year. Contributions are taxed in pre-tax contributions upon distribution. For Roth after-tax contributions, it's upon the contribution. Required minimum distributions do apply to both pre-tax contributions and Roth after-tax contributions. And Fidelity will be talking more about this later on, so we'll allow them to elaborate a little bit more. So which funds would you like to choose from? Options are available, and what Duke has done is they've divided the options out into 3 tiers. Duke has an investment advisory committee that have chosen a group of funds, and they're regularly monitored between tier 1 and tier 2 to ensure they remain appropriate investment options for the retirement plans. So again, the investments are grouped by tier. Funds in tier 1 and tier 2 are monitored by the investment advisory committee. They meet every quarter to analyze the options or the investments in the plan. And so you can keep that in mind as you're making choices. Fidelity is the primary record-keeping and retirement services provider. Duke also offers a choice, a tier 3, which is a self-directed brokerage account, and that particular option is not monitored by the investment advisory committee. I'd like to note that in option tier 3, there are over 11,000 funds to choose from, so you can only imagine trying to monitor that. Okay, so if you leave Duke, your vested 403B funds can remain in the plan until age 70 and a half, where you will be subject to required minimum distributions. You can roll over into a new employer's 403A, 403B, 401K, or governmental 457 plan. You can roll it into an IRA, or you can withdraw as cash. There may be IRS penalties that could apply. So we're going to go ahead and transition now for Fidelity to help describe a little bit more about understanding your investment options. I invite them to come up now, and I thank you for having me today. We'll be available after this session is over as well. Thank you.
That's right.
Check 1, 2, 3.
Good. All right. So good afternoon, everyone. My name is Alan Collins. I'm joined by Ben Parker. We are both with Fidelity, and we're also here with Carmel Lewis, seated right here in the front row, and Chris Mann is in the building as well. So the four of us, before we get into the funds and getting into the details of the funds. So the four of us are actually on-site planners. Some of you may have met with us already, so we may look familiar to some of you. If not, you can utilize us on-site. We do cover about 20 to 25 different locations that we have where we have one-on-one appointments. We can talk a little later about how you can make an appointment if you haven't already done so. But with that, we will go ahead and jump right in. This is a really important topic as we talk about the different investment choices in your plan. especially because of what's happened in the last year. So unless you're new to Duke, so how many are new within the last 3 months? Maybe a few hands, right? So for the majority of the room, a lot's changed in the last year as far as the investment, the overall faculty and staff plan goes, where we went from 4 vendors down to 1 essentially. And that means big change overall, going from having maybe 1 advisor that you were used to seeing for a long time and then making a big transition. But another really big transition is going from having certain funds with your previous investment provider and then having to get used to a new lineup. So as we think about the new Fidelity lineup, if you haven't already done so, it's going to be really important that you take a look at what your portfolio looks like within your new plan. And a big reason for that is because you may, unless you've actually gone in and changed where your future money goes, if you're contributing to the plan, and if you're getting Duke contributions as well, if you haven't changed where that money goes, chances are it's actually going into one of those target date funds that Sarah just talked about. So it's going to be really important that as we go through this, as you think about how you want to reshape your portfolio, we can help you with that, but it's going to be critical that everyone take a step in doing so going forward. So let's go ahead and jump right in. All right, so I'm not going to read this verbatim, but as Sarah mentioned, there's 3 different tiers. And it starts off with the first tier, which is target date funds. They're all Vanguard funds, so don't be too confused. It's not that you're now with Vanguard, but you may have a Vanguard fund within your Fidelity lineup. And I tend to think of these as these tier 1s being more of a hands-off approach. So tier 2 is definitely more hands-on. So when I say hands-off, if you tend to think of yourself as having maybe not as much time as you'd like to be able to spend on this, or if you're not, if you don't have the knowledge yet to be able to make your own decisions, or if you don't have much desire to want to do it, maybe this isn't all that interesting to a lot of you, then maybe the tier 1 approach would work best, but it would help to talk with us to determine that. Tier 2 just allows you to be a little more selective. So there's about 12 target date funds to pick from, then there's 28 other core investment choices, so those are your alternate choices that you can pick from. I really like to spend time on tier 2 when I sit down and meet with employees, just because it's important to look at the different funds that are available to you, and it really allows you to build your own portfolio, whereas their tier 1 approach is already a pre-built portfolio for you. The one really nice thing about tier 1 target date funds is, and we'll see them on the next page in just a moment, but as you think about your age now and when you may plan to retire, if it's in the year roughly 2035, or maybe it's the year 2025 or 2050, whatever it may be, each portfolio is going to look a little bit different depending on how far away you are from retirement. So we'll touch on that, and we're going to see a whole lot of pie charts in just a few minutes. But lastly, the tier 3 section, as Sarah mentioned, there are thousands of funds that are available to you. So it's not the most popular choice. I personally think you have a lot of really great choices available to you in tier 2. But what that does give you the option to do in tier 3 is if you wanted to look at investing in anything specific, like any sector funds like technology or medical technology or healthcare or whatever it may be, you'll notice in tier 2 right now you don't have those choices to pick from. And if that interests you, tier 3 is an option where you can look into that. It does mention at the bottom or in the middle that the investment advisory committee neither evaluates nor monitors those funds. Again, it's thousands of funds, so it is almost you could say at your own risk. But that is available to you, and it also talks about additional fees that may apply. There is no additional fee to open the brokerage link account, but depending on the investments you choose, some may have additional fees to purchase them. Some don't have any additional fees. So just to point that out as well. So I won't spend too much time here, but this is just talking about some of the examples I mentioned. Depending on what your target retirement date is, you may already have your money in a target date fund at this point. And if not, and if you're not sure, there's easy ways to check for that online. So, and then this talks about the tier 2 choices. This is the additional 28 funds that you have available to you. And it breaks them down not only by name, but it also talks about the asset class, which we'll get into in just a minute. So you'll see mid-cap blend, mid-cap growth, foreign large blend. These are all the different asset classes that make up your available options. So determining which ones are most appropriate for you, unless you're really knowledgeable in this area and you have a lot of experience, we're here to help you with that if you did want to build your own portfolio. And then lastly, brokerage link. Again, it gives you the flexibility of having a brokerage account. So you want to think of it as, let's say you opened your own individual account like an IRA, whether it's traditional or Roth. This gives you the flexibility of investing in thousands of different mutual funds. You can't purchase any individual stocks, like if you wanted to buy an Apple or a Google or anything like that. You can't do that individually. But what you can do is buy certain mutual funds that invest in categories that you might like. Okay, so let's talk about, before we can even think about choosing which funds might be most appropriate, we need to make sure that we have goals. So let's talk about defining goals and what that looks like. All right, so the first thing we have to determine is what are the goals, right? So if you're saving in your Duke faculty and staff retirement plan, most likely you're saving for retirement, right? So that would be one goal, but you can have, there's other ways to save. There's other goals that you may be saving for, whether it's college savings, in which case there's 529 plans, right? If you wanted to save additionally for retirement, you may consider a separate account like a Roth IRA. If you're thinking about saving for a shorter term goal, whether it may be saving for a house or a vehicle or whatever it may be, there's different types of accounts and different ways to invest for those goals. So, we want to think about your time frame, what your time frame is, and lastly, how much do you need to save for that? That's usually the hardest question to answer, but the good news is we have a lot of planning tools that we use in our appointments. We have planning tools that our phone associates use as well, and it's actually called the Planning and Guidance Center. It's available to you right on netbenefits.com, which is your Fidelity login site, if you haven't already seen it. And that actually helps you determine, based on the goal and based on timeline to retirement, how much you may need. So it gives you that target dollar amount that you may need to reach. All right, so let's get into building an investment plan. So first of all, and no one has to shout out answers here, but just think about this for a minute. So how comfortable are you with risk? And Ben and I, we meet with people every day that are at different, that are on either at the left or the right or right in the middle here in terms of where they are with risk. So whether you're someone that can handle it really well, that could depend on a few things. It may just be it might just be your makeup and how you handle things emotionally when it comes to risk. But when you think about it financially, you want to think about timeline, right? So if you're, for example, there's a really wide range of age groups in the room, but let's say you're 25 and your goal is to retire by the time you're 65 potentially. Well, that's 40 years, right? So you might, based on that, take on a lot more risk than, say, someone who's 55 or 60 and approaching retirement. That portfolio could look a whole lot different. But even with that said, we don't just want to think about time frame, right? There's a lot of things that determine how much risk you might want to take. And one of those things is, if you think about one of the things Sarah mentioned, which is a pension plan, if you're going to be covered by income like Social Security, a pension plan, and maybe additional income in retirement, whether it might be rental property, the sale of a home, whatever it may be, you may have additional assets that you can rely on. So it's going to be important that we don't just zone in on your Duke 403B plan and look at that solely as the one account you have and decide what your portfolio looks like. There's a lot of other things we want to look at. So let's go ahead and jump to the next page and think about different levels of risk, right? So there's a lot of different risks out there, but these are the two main risks that we talk about when it comes to investing. So one of them is inflation risk. So inflation being the overall rise in prices of goods and services. On average, what do we see that? Roughly 2 to 3% on average, right? So we have to keep up with the overall rise in prices over time. And that's one of the risks we want to account for, so we want to think about investing for that. The other thing is investment risk, And thinking about whether it's college savings, whether it's saving for a house, whether it's retirement, we have to make sure that the investment approach we take is appropriate based on those different goals. Okay, so I promised some pie charts. We're going to see a whole lot more now going forward, but the first thing we'll talk about here is asset allocation. So typically when I look at a portfolio for anyone that I meet with, the investor has a piece of all three of these, right? So every once in a while I have someone who's 100% in stocks, and that's a very aggressive approach, or I might have someone who's 100% in short-term investments, which is very safe. Stocks are the highest risk of these three categories, right? So you have stocks, bonds, and short-term. So they have the highest risk, but also the highest growth potential, right? So as you might imagine, the size of your slice in stocks versus bonds and short-term is going to vary depending on how far away you are from retirement. You'll also notice that this not only talks about asset allocation, but diversification. So asset allocation is making sure that you have money spread out between the three different asset classes. Diversification is making sure that you diversify within those classes. So when you have stocks, you want to make sure that you have a variety of large caps, mid caps, small caps, internationals. And all we're talking about there, just to make it really simple, when we're talking about large caps, we're talking about bigger companies versus mid-sized companies versus small-sized companies. So you're investing in a variety of different stocks. And an example of a large cap, one of the funds that we looked at earlier, there was a Fidelity Contra Fund, there was a Vanguard Institutional Index Plus. Those are large cap funds, and they invest in big companies like your Amazons, Googles, Microsofts, Visa, huge companies. And you can actually see what some of those holdings are for the funds. And we can talk about how you can get there later. But this just breaks out the importance of making sure that your portfolio is diversified. So if you have money in stocks, you don't necessarily want to have it all in one stock fund. You want to make sure it's spread out across a variety.
And real quick,
Yeah.
Alan, just to tie this back to the previous slide. So on the previous slide, you had the two types of investment risk. So you had inflation risk, then you also had investment risk, right? This is how you counteract those different risks. So if you want to hedge against inflation, you want to have assets that grow, which are stocks. So stocks will help you grow and keep pace with the rising cost of goods and services. If you want to hedge against market risk or investment risk, you have more safer, secure vehicles like bonds and like short-term securities. And so the importance of having a proper asset allocation is the collective of all three helps you balance out and prevent the two biggest risks that we just talked about in the previous slide. So that's the kind of the reason for having an asset allocated portfolio to hedge against those two risks we just saw in the previous slide.
Perfect. Okay, so we talked about some of the factors that go into determining the portfolio. Time horizon is definitely one of them. So as you'll see here, if we have more of a long-term view, the dark blue section of that pie chart is stocks. So you'll tend to see more in stocks. You can be comfortable investing more in stocks with a longer-term goal, such as retirement. And something like a potentially short-term goal, if retirement is in the short term, whether it's within the next 5 years or so, then a short-term goal could you could be investing the majority of your money potentially in bonds and cash to help protect savings and reduce risk. And we don't want to eliminate risk altogether because you still want to make sure that your accounts are producing income. But this just gives you an idea, again, about all these different examples. Okay, so here's a good example, too, of different types of allocations, right? So if we look on the far left-hand side, aggressive growth would be defined as a portfolio that's roughly 85% in stocks or more, right? So if we look at 85%, with 60% being in domestic stocks, so that's your blue slice, foreign stocks at about 25%, so that's your 85% stocks, 15% bonds. That's appropriate typically if you're about 13 plus years away from retirement, or 13 plus years away from whatever your investment goal might be. And you can see there's different categories. I won't go into each of them, but if we go to the far right, we have a balanced portfolio, which is typically appropriate for someone who is less than 5, or anywhere from 5 or less years to retirement. And That's more of a 50-50 portfolio. So what a target date fund does is if you're already, let's say 20, 25 years from retirement, your target date fund will actually be about 85 to 90% in stocks now. And what it does automatically is it reduces the risk for you over time. So a lot of people like those funds, more than 50% overall. In fact, I just saw a study that was just released from Fidelity at the end of last year in 2018, that at this point now more than 50% of savers within 401k plans are 100% in a target date fund. Okay, so it's not a bad thing. It's just one approach versus the other. But this just kind of gives you an idea of how you could potentially look to invest depending on your timelines. Now this one's really interesting to see. So if we look at performance, I want to point out this is not what you would typically see online. So if you were to go online on netbenefits.com and you were to look at the investment performance of all of the funds that are available to you, it'll show you the average over the last year, over the last 3 years, 5 years, and 10 years per year. So what we're showing you here is what happened in January of 2008, and everyone remembers that downturn in the market, right? So January of 2008, everything was looking pretty good. We don't have a chart here to show you what it looked like just prior to that, but everything was looking pretty good in the market. And if you look at January of 2008 to February of 2009, we're talking about a roughly 13-month period here where an all-cash or short-term investments portfolio would have been about 1.6% in terms of the overall growth rate that year. A diversified growth portfolio, so we're talking about 70% stocks, 30% bonds, was down 35%, and an all-stock portfolio was down 50% in just a year. So, Ben and I have been with Fidelity for a long time. Chris and Carmel, we've all been with Fidelity for a long time. We were around when this happened, and we spoke with, thousands of employees back then who were at all stages of their career, but many who were planning to retire, and unfortunately, many who had number 3, an all-stock portfolio within a year, 2 years before retirement. So that was obviously a terrible time in the market, and it changed many people's plans for retirement. So many had to continue working when that wasn't their plan, to basically continue to contribute and boost their savings and wait for the market to rebound, which it did, but it took some time. So if you look at between March 2009, as the market was rebounding, and February 14, the diversified growth portfolio the overall growth rate on that was up almost 100%, and an all-stock portfolio 162% over that time frame. So the most important thing, though, because we're talking about the importance of diversification here, is when you look at the January of 2008, so the beginning of the downturn, to February of 2014, what you'll notice that a diversified portfolio, even though it wasn't quite as good overall in terms of an all-stock portfolio, still performed really well. And that's having significantly less risk than a 100% stock portfolio. So you don't just want to, this is really important because when you look at your funds that are available to you on the Duke site, you'll see some that have averaged over the last 10 years, 17%, 18%, 19% per year. And if you compare that to some of the other balanced funds or target date funds that are maybe 12, 13% a year, you might initially say, well, I'm just going to go with that because that's performed the best, so why wouldn't I just go for that growth rate? But there's more risk involved. So you just have to be careful to make sure you're balancing the risk versus your timeline and your overall risk tolerance. But this is really neat to see because you can see the wild fluctuations with all cash versus all stock, and then the importance of diversification in the middle. Okay? Anything to add there, Ben?
Yeah, I think the biggest thing for me, and so this whole process is about identifying your goals, identifying your time frame, identifying your appropriate risk tolerance, and to help you choose the investments. The one thing that I saw a lot back then was that we started out with the all-stock portfolio. 2008 hit. We rolled it till we couldn't take it anymore. Around March 2009, April 2009, threw up our hands, we got fed up, sold out of the portfolio, went into cash. Mm-hmm. And so more times than not, people sold at a 50% loss, bought into something that was paying less than 0.5%, and rode it out until probably recently and missed all of the rebound, right? And so I think that's the important part of making sure up front you determine what is the appropriate amount of risk for you to take so that you can build the appropriate portfolio, because the ideal is to find something that's comfortable for you, that allow you to stay invested through these swings so that you can have the proper outcome on the back end, you know, versus kind of making that, like Alan says, don't go in and just pick the first fund that has the best performance, because then you'll start to find yourself making some knee-jerk reactions probably at the worst possible times. So as you begin to think about building your own portfolios and building your own strategy, really think about what is a comfortable amount of risk for you to take to build that right diversified portfolio.
So here's just a quick trivia question. You guys can chat out the answer if you like, but how should you adjust your portfolio as you get closer to a goal? It's a little bit of a trick question because some might look like the right answer, but they may not be. So what do you guys think? Would you increase your stock percentage and lower your bond as you get closer to a goal? No? Okay. Increase your bond, so go the other way, increase your bond percentage, lower your stock portfolio? Maybe. Go with a 50-50 mix of stocks and bonds? Maybe. Or no. 25% stocks and bonds, 75% cash? Okay, so it depends, right? Now, the answer, you'll be surprised, or you may be surprised, is actually B. So it's going to be to gradually increase your bond percentage and lower your stock percentage. The others, C and D, could work, but typically that's what you want to take, is the approach to lower your overall stock percentage and increase that bond percentage. Again, just to reduce the risk. It doesn't eliminate risk, but it reduces the volatility. So bonds are much less volatile than stocks overall. So that's all we're trying to do there, is reduce the volatility. You still have growth potential, but you're just lowering it a little bit. Okay, so let's go ahead and get into investment funds. So things we want to look for when we invest are certainly returns. There's different types of investors that may target certain funds. So let's get into that a little bit deeper on the next slide. So there's different types of funds offered in your plan. There are actively managed funds, and then there are passive managed funds, or passively managed funds. So what you'll notice here is that actively managed funds, and examples of that are, I'll just name a couple that you'd be familiar with in your plan. The Janus Henderson Triton Fund, it's a small cap growth fund. Fidelity Contra Fund is a large cap growth fund. There's an American Century Mid Cap. These are all actively managed funds, right? So there's fund managers that are managing the funds. They're determining the holdings, meaning they're determining which companies each fund is actually investing in. And as a result, they each have costs that go with it. So you'll see they generally have higher operating costs, which you guys as the investors are actually paying. So when you see a fund that has an expense ratio, that's what you as the investor are paying. Okay, so actively managed funds have higher costs, but they do have the potential to outperform the market. And really that's why you're investing in an actively managed fund, is to try to beat the market. Whereas on the right, you have funds such as the Vanguard Institutional Index, the Vanguard Extended Market Index. Some of these are index funds, right? So they're not trying to beat the market, they're just trying to mirror a market, such as an S&P 500 or a Russell 2000 index. Those are different indices out there. And there's funds that simply try to match what the market is performing. And as a result, you pay a very small amount. In some cases, for example, the target date funds are 0.09%. There's others, I forget the institutional index now. Is
0.02.
0.02,
Yeah.
right? So they're in that range, really low, whereas you might have other funds that are 0.5, 0.6, 0.7%. And they're higher costs, and in some cases they're underperforming relative to the market, in some cases they're outperforming the market. So you just want to make sure that that's part of your overall research, and we can help you do that. So we're not going to leave it all up to you. We can help you navigate that to see what's important. And these next few slides are really just to give you an idea of what you can see when you go online. So this is an example of a style map. So for example, for stock funds, if you click on any of the funds that are available to you, you'll have a section where you can see what this style map looks like. And you can see, number one, it just helps you determine, is it a small, mid, or large cap, which you can see on the left-hand side. And secondly, in terms of valuation, is it considered more of a value fund where it's considered undervalued in the market, generally cheaper, or is it a growth fund like a Fidelity Contra Fund or something like that, which is poised for growth, right? So more or less, this is just part of what you can research when you look online. So we can jump to the next piece here. This talks about bond prices. So we talked about stock funds and different types of allocations within stocks, having large companies, mid-sized companies, small-sized companies. With bonds, you'll notice here it talks about different interest rates. Really, there's an inverse relationship between bond prices and interest rates. So as interest rates go up, bond prices fall. As interest rates go down, bond prices go up. Now, overall, you tend to see a lot less fluctuation with bonds versus stocks, which is why they're a really important piece of your overall portfolio. And here's another style map that talks about bonds and, again, and how they work and things you can look for here in terms of the interest rate sensitivity as well as the quality of the bond, right? So you may have a corporate bond versus a government bond, and that government bond tends to be safer versus a corporate bond, which is not. So the credit quality may differ depending on the types of bonds you choose. And just to give you a heads up, there's 28 of those core options available to you, but of those 28, most of them are stocks, right? So there's a few bonds. There's a Metro West bond. There's a PIMCO income fund. There's the Vanguard Total Bond Index, and then there is also another one that's listed as a bond, which is your stable option. So there's a VALIC, it's called the VALIC fixed interest option. So that would be your stable fixed interest fund. I think right now it's paying at 2.5%, but it is subject to change. So those are just different examples of funds that are available to you. But again, this is just something else you can look at. So as we think about accounts, and this is a really important one, right? Because as I mentioned, you don't want to just look at your 403B when you're thinking about reallocating. If you have other accounts, if you have a 403B elsewhere or a 401k from a previous job, and some of you that just came to Duke, you might be thinking, gosh, I have an old 401k or a 403B elsewhere, or maybe I have 3 or 4. That happens too. And it's important that you keep an eye on those and make sure that you're investing appropriately within those accounts. And in some cases, it makes sense to just look at consolidating the accounts, which you can do. And it just allows you to keep a better eye on things. But overall, as you're doing your research, you just want to make sure that you're monitoring. These are just good rules of thumb. Monitoring consistently. It's not something where you have to be making changes every few months or even every quarter or anything like that. But we always say it's a good idea to do a checkup once a year, just like you would for your own health. And get that annual physical. You can do an annual exam of your overall financial health as well. So overall, things to think about when you evaluate your investment choices. These are just a few different things to think about and look at. So long-term performance. We don't just want to look at a fund that's done well over the last 12 months, right? We want to look at the history. How well has it done over the last 3 years, 5 years, 10 years, maybe even 15 years if we can look that far back. Take a look at the rankings and ratings, right? So there's a group out there called Morningstar. Some of you may have heard of Morningstar. If not, you can go to the morningstar.com website. Great place to just do an overall evaluation on any fund out there that you want to look at. And then it gives you rankings and ratings based on each one. Also, risk measurement. There's a variety of different risk measurements you can look at for each fund, as well as expenses. That's a really important piece. Comparing your fund to an S&P 500 or a Russell 2000, right? So if you have an actively managed fund, you want to see how is it doing relative to other indices. Is it outperforming them historically? Is it not? And if not, why not? And should you consider it? And then lastly, the top 10 holdings. So for any of the funds in the plan, you can see, for example, if they invest in 500 different companies, it'll show you the top 10 right there, which usually make up 30 to 40%, if not more, of the portfolio. If you ever want the full list, which some employees always want that full list of holdings, you can get that too. It's right in the prospectus.
I think the important thing just to kind of mention here is that it's several different pieces when it comes to evaluating your funds and evaluating your investments. You've noticed the long-term performance is on here. You probably have heard it all either on commercials or in disclosures. Past performance is not a promise of future performance. So it's not the only measure, but looking at this in a collective, it'll actually help you kind of narrow down what are the best investment choices for your situation. Even in terms of the rankings and the ratings, today's 5-star fund for Morningstar could be tomorrow's 3-star fund. And today's 3-star fund for Morningstar could be tomorrow's 5-star fund. So, in terms of picking and choosing your own investments, and this is where, Alan and I and Carmel can come into play to kind of help you guys out, is there's several different things we want to consider when we're making these investment choices to pick the funds, for you to pick your funds. So you want to make sure that we're actually having a keen eye on all those and not just focusing on maybe, one or two.
Okay, so again, overall, just going back to what we discussed, overall, just think about target asset mix and what you may need to do going forward. So big things that go into that time frame, overall financial needs, will you have a potential need for some of this money in the near future? So for example, if you're retiring in the next year, but you may need access to some of this within the next year or 2 years, you may want to put some of that money in a very safe investment like a stable value or a money market investment, just to make sure it's going to be there, more or less. So again, those are things to think about as well. And then overall, you have to be comfortable with your risk. So you shouldn't be thinking about wanting to change things every month, every quarter. Can you do it? Yeah, you can. But typically, you want to make sure that you want to have a strategy that you feel comfortable with, not just for the next few months, but for the next several years, that you can maybe tweak it from time to time. But that's going to be the biggest thing going forward. Here's just another example. So we have Jane, who actually has an aggressive approach. So you'll see her first thing that she wants to determine is the allocation, which is an aggressive approach. So she'll have about 85% in stocks, 15% in bonds. And then from there, she'll also determine the allocation within her stock, which is a variety of growth funds, maybe some small cap funds, some value funds. So again, just going back to the importance of spreading out risk. And then lastly, selecting those investments. So if you haven't done it yet, we can help you do it. We navigate these websites every day, so we know exactly where to go. And people always say, oh, you guys make it look so easy. We happen to have seen these and gone through these clicks multiple times. So if you haven't done it yet, we're here to help you. All right, you can either give us a call or go right on the website, and we can do that. We can do that with you during an appointment as well. So I think there may be one more here before I get Ben. All right, that's it for me. I'm going to let Ben kind of go from here.
All right, so I think the biggest thing is once you've identified and narrowed down, hey, what's going to be my asset mix? What's going to be my target percentage between stocks and bonds? Right? What's going to be my diversification amongst those stocks and bonds? It's kind of putting together a process of how you're going to manage and monitor your plan moving forward. Right? Things change. So one of the things that I hear a lot with this conversion, that when everything came over to Fidelity, I say, hey, how did you pick your funds? I met with someone that helped me put it together 6 years ago, right? How have you monitored those investments since then? I haven't, right? And so that's kind of it's important to pick the right mix in the beginning. It's important to pick the right diversification, but it's also equally, in my opinion, in some cases, even more important to monitor your selections and have a repeatable, definable process to monitor your selections moving forward. To one, just make sure that your level of stock and bond ratios is still appropriate for your time frame. And then make sure that the investments you have selected within those are still appropriate. As I mentioned before, today's 5-star fund is tomorrow's 3-star fund. And so we want to make sure that those investments are still aligned with your overall goals. So I'll give a classic example of maybe how to reallocate your portfolio, but also how things can kind of get out of whack. So if you picked a 70-30 mix between stocks and bonds 5 years ago, because the markets have done so well over the last couple of years, maybe a couple bumps in the road here and there, but for the most part, the markets have done well, right? You can ideally look at your portfolio today and have 80% of your money in stocks and 20% of your money in bonds, off the sheer fact of how much the market grew over a 5-year period, right? You can also look into that same portfolio. You may have said, hey, put 10% of my money in Contra Fund and 5% of my money in the Janus Triton, and you can look up today, and now 15% of your money is in the Contra Fund and 10% of your money is in the Triton, right? That's not a bad thing. It's a good thing that things grew. This is why we invest. This is why we put money in the funds, because over time, as the market does well, we want those investments to do well also. But you need to go back in and reposition your portfolio over time to get yourself back within an alignment. So if you want to, kind of reallocate your investments, you do a process to maybe sell some of your Contra and bring it back down to 10%, and sell some of your Janus Triton and get it back down to 5%. But you also want to have a process to rebalance your total portfolio, right? And making sure that if you start at 70 and you end up at 80, how do you get yourself back down to 70 so you're not taking on more risk than what's necessary? I think we normally call it portfolio drift, where you just let your portfolio just drift higher and higher and riskier based off of what the markets are doing. So there's two different investment approaches. You can be more, I think Alan mentioned earlier, you can be more hands-off, where you say, you know what, Ben, this is a lot of information, this is a lot of work, and I don't see myself having the skill, will, or time to do it. So give me a process that would do all these things you guys just mentioned for me. Or you can have I think I said that backwards, or you can have an approach to say, hey, I have the skill, will, and time, and I want to do all those different things. For someone that have the skill, will, and time, you can do it yourself, and we can help with those resources. For someone that says, hey, I need help, I'm more of a delegate, I want to delegate that responsibility to Fidelity, then that's where we can offer the professional help. And then within your Duke plan, that professional help is the tier 1 options, those target date fund solutions that we have available for you. Now, let me ask you I asked you guys a question. Feel free to chime in or raise your hand. Should you have more than one target date fund in your portfolio? Who feels the answer is yes? All right. Who feels the answer is no?
Are you going to have several funds? Are you going to have 2 different funds then for 2 different target dates?
Mm-hmm. Gotcha. It was about half and half on that answer, but the answer is no. Target date fund is a single fund solution that is basically doing all the things that we just discussed in the earlier part of that presentation. They're doing it all for you, right? And so having multiple target date funds is like basically having at a dinner multiple cakes and they're all the same type, right? You're not really doing anything else but just adding more of the same. So having one fund is sufficient, because underneath that fund, it's doing all of the allocation and the diversification for you. Kind of went over that part of it. All right. How frequently do you guys think you should review your investments? Never. So, the answer here is annually, right? You should at minimum review your investments on an annual basis. I would normally take it a step farther and say it depends, right? It depends on if you're hands-on and hands-off. If you're hands-off and you have a target date fund that's doing the investments for you, yearly is sufficient. Meet yearly, review your investments yearly, make sure that that target date is still aligned with when you're actually going to retire, because maybe you thinking 65, but it ends up being 60, so we need to make them do a more conservative move to a target date fund. If you're more hands-on, maybe a lot more regularly, maybe semi-annually, you want to review your investments. Depending on how aggressive you are, maybe quarterly. Now, you don't want to obsess about it, right? You don't want to be in the account every single day. You don't want to let the news have you making emotional decisions about your investments. You just want to have a more realistic, process in place to review things more continuously. And I would say at a starting point, at bare minimum, it should be annually. A lot happens in the market over the course of the year that we need to take a look at and pay attention to. So taking the next steps. All right. So I call this more so like your blueprint in terms of starting with investing, right? You want to define your goals. Is it for retirement? Is it for a home? How long of a time frame do you have, right? What is your style of investing? Are you more hands-on or hands-off? Build a plan around your goal and your time frame and how you are as an investor. Making sure that the investments that you have selected, or if you use our help to select, that they're diversified, they're allocated properly, and then reviewing the portfolio at minimum on a yearly basis to make sure that the portfolio still aligns with your goals. So in terms of next steps, there's several different ways that we can help you guys. For those that are more do-it-yourself, hands-on, you want to get in and pick and choose your own investments, you can use our tools under the Planning and Guidance Center. So if you log into your Fidelity account, there's a link at the top that says Planning. You can go there. You can use the Planning and Guidance Center to put together a model portfolio or investment strategy for your portfolio. You can utilize us as planners as well. So you can go into fidelity.com/meet and book an appointment with any one of the four of us directly online. You can call the number that's listed here. We understand that sometimes there's schedule constraints, or maybe meeting in your normal 9-to-5 setting is not the best for you in terms of how you work, but we have phone planners that do the same thing that Alan and I both do. They just do it over the phone. They're available from 8 a.m. to 9 p.m. Eastern time, so you can use them as well. And for those that are more tech savvy and like to have their accounts with them on the go, I think it's a very good resource to use our Net Benefits app. You can download that app from the Apple Store or the Google Play Store. Use your same Fidelity login to view it. You can make changes to your portfolio there. You can make changes to your investments there. Pretty much anything you can do on the Fidelity website, you can do right there on the app as well. So it's a pretty easy to use feature to stay connected with Fidelity and your account. All right, so thank you. We do have a little bit of time, and so we can open the floor up for any questions that you guys may have. I think they had one right here. So the question was, if I have an outside investment account, can I contribute in a Roth through Duke? And I want to clarify, are you talking in terms of a Roth IRA separate from the Duke plan, or just do Roth contributions inside of your 403B? Yes, you can. So you can create a separate one within Fidelity that'll be attached to, it wouldn't be under your Duke account, but it'll be attached to your profile. If you do the 403B, the Roth contributions, then you don't have to worry about the income limit. You just worry about contributing up to the maximum, which is 19,000. So there's no income limit to do a Roth 403B. So do Roth contributions inside of your Duke 403B. There's no income limit. It does. It does. But if you do a Roth IRA, which is separate from your, so individual account separate from your Duke 403B, then we have to look at the IRS income limits in terms of making those contributions. But to do a Roth contribution inside of your 403B, there's no income limits. Okay.
So I'm contributing as much as I can to my Duke 403B, and it's a target thing. And can I just, I think when we were switching, Fidelity percent set up a Roth for you, but I've never put any money in it. So can I just put money in that instead of like when I'm doing this joint target, can I just change it to Roth?
Let me just clarify. So in terms of, so you set up a separate Roth IRA? Okay,
Right?
yeah,
The Fidelity guy did it when we, last year, had that big switch over.
okay.
Because I wanted to do it, but no money is coming in. So, do I go to you guys to do that, to help me, and some of that money that's going into the target go to the Roth?
So, yeah, so the target date fund or any fund, those are all the individual investment choices you can pick from within the plan, right? That's where you can decide where your money goes. Roth is a type of money that you choose to contribute from your pay. So when you contribute, you either contribute pre-tax or Roth into your Duke plan. And then once that money is in the plan, you determine how it gets invested. So that could be in a target date fund or any of those other funds we talked about. Does that make sense?
If I'm contributing my max, because I want to retire really soon, can I still put money in Roth?
Yeah. Yeah.
Even
So.
if I'm already doing my max?
Well, if you're already maxing out, so what you could, so it depends, right? If you're maxing out your contribution amount, it can be a combination of pre-tax and Roth, or it could be all pre-tax, or it could be all Roth. So there is, and we can sit down and talk
Yeah.
about it. But because I think the key thing is going to be to look at, from a tax standpoint, how you want to contribute going forward until you retire, but also how that money is invested. But to answer your question, as far as where money gets routed to and how you can invest it, we can absolutely change that. Yeah.
And the way to get a point with you, you just have to go onto the Fidelity site /meet and
Yeah. So I think the easiest way to do it, honestly, I mean, you can call, but you can also just go right online. And if you go to fidelity.com/Duke, it's a really nice looking Fidelity site dedicated to Duke. So it has all of the Duke resources there, but there's a link, it says Meet. And you can just click on Meet, and it'll show you actually all of the different locations that are available that you can meet us at.
So you have to meet in person.
And it's at the
You
bottom
don't
right
have
hand.
to, but it actually has, so if you call the 800 number, you can speak with one of our guidance representatives right over the phone. And it might just work for most people too, because if it doesn't work schedule-wise, you can just talk to someone today. If you prefer to meet in person, you have the four of us that are on site just about somewhere at Duke every day. So we cover, I mean, just in terms of some of the locations, DMP, Duke South, Duke Regional, Duke Raleigh. We actually hold meetings at the investor centers as well, the Fidelity Investor Center in Durham, which is by South Point Mall. We hold meetings over at Fidelity Raleigh, which is by Glenwood Ave.
Bryant Center.
What's that?
The Bryant Center?
Bryant Center.
Bryant Center.
A variety.
Variety of places,
So there's
yeah.
tons of places we can have meetings.
is that Fidelity place by South Point? If I had a point with anybody there, they would understand the Duke stuff too.
We would understand it better,
Yeah.
quite frankly, just because we're in it every day. But that being said, they lean on us for questions as well. So if you already have an ongoing relationship with someone within a branch, if they want to tie us in for any questions, they'll do that.
They'll do so.
Yeah.
Make sure when you go to the website, to the bottom right corner. So scroll all the way down to the bottom right corner, and you'll see the Meet link, and then click on that link right there to see all the locations.
Thank you.
Sure.
I think you had a question.
Once you reach with the max contributions, like does Duke or do
Yeah, it'll stop you,
Stop
but
you.
this is one thing you want to be careful with is, let's say you have 2 jobs, right? Let's say you're contributing to multiple plans. That's where some people run into problems, right? Because those 2 plans don't talk to each other, right? So let's say you work with, I guess I shouldn't say UNC, right? But let's say you work with UNC and you also work with Duke and you have 2 jobs,
Yeah.
and you're contributing to both plans, and let's say you're under 50 and you can contribute up to 19,000. Well, that's for, that's combined, right? So let's say you've put 10,000 into one and 10,000 into the other. They don't talk to each other, those 2 plans. So that's up to you to track it. But if it's single employer, if it's Duke, yes, yeah. And maybe Catherine can just, because we have Catherine here from HR as well, if you can just confirm, if someone is concerned about over contributing to their plan, if they have it set up, does the payroll system automatically cap them?
It stops it.
Yeah.
It does.
You can put 80% of your salary, but our system will cut you, will not allow you to go over the limit.
Yep.
And then if you have additional savings, is it possible to then put your savings, like after the fact, into these plans, or does it just have to be deducted from your paycheck at the time of your paycheck? Is that correct?
It has to be payroll deducted.
So just repeat the question too.
Some people receive some money and they want to invest that in the plan. What you could do is to adjust your deductions, your payroll deduction, and then use the money that you have over there.
And just to repeat the question for online, so the question was, if I have money sitting aside in outside savings, I get to the end of the year, I want to put money in. Can I put money into my Duke 403B plan? Is it allowed? And the answer is no. You have to do additional kind of outside investment, IRAs or savings, but you can't take that money and put it in. It has to be payroll deducted.
So if you're married, and so both people are contributing towards retirement separately, and then you get, like, I'm doing my max, but I still want to do Roth, but that person contributes too, and you're married, so, I mean, IRS knows everything. I mean, is there a rule that says you can't contribute to Roth? Isn't there a rule?
So I'll give you, so I guess is there a rule that says you can't contribute to a Roth based on income? So in general, yes, there's income limits, right? So it takes, if you guys are married filing jointly, it takes a combined adjusted gross income. And if you fall under a certain range, then you can contribute. If you fall in between a certain income range, you can do a partial contribution. And if you over a range, then you can't do any contributions. So I think the first thing, that probably would be a very good topic in a one-on-one. So you can look at what your total adjusted gross income is. We can pull up the tables, the IRS tables, and look at where you would fall. And that will let you know how much you can or can't contribute. So if you over those income limits, technically you can't contribute. There are some other, loopholes that's probably best for an appointment, but there's also other ways that you can probably get around it. But in general, if you're over this selected income limit, you can't put any money into it.
And you're referring to a Roth outside the plan?
Yes.
Because
Yes, there's-
inside the plan, the limit is your individual limit. If your limit is 19,000, you can do 19,000 regardless of your salary in the Duke plan. You can do Roth, you can do pre-tax, you can do a combination of the two, and it's per person. But it's not about the retail Roth IRA, or there's some salary limitation.
Mm-hmm.
What was the thing about you have to have had it 5 years ago or something? Someone said you should have had a Roth 5 years ago.
So for the Roth, for the money you put into a Roth, so generally the money you put in is after-tax money. The growth on that money is tax-free. So we put in 5, it grows 10. That $5,000 that it grew is tax-free, right? In order for you to be able to access that money and it be tax-free, you have to have had the money in a Roth for 5 years or be age 59 and a half, whichever is greater. So with you starting, if you do Roth contributions inside of your Duke 403B, once you start that, the clock starts. So at some point, if you retire later and you're at 59 or you're at 60 and you want to start pulling money out, you can pull money out tax-free, no problems.
So I'm 62 and a half now.
If you just start now, yes.
Yeah, and that's just the earnings, because theoretically, the money you put into it, you can get back out.
Yeah.
It's just the earnings. So the same example, if you put 5 in, you can get that 5 out at any point, barring you can take distributions. That's a different story, but you can take that 5 out at any point. It's the 5 that it grew, that growth, that's the money that has to age and be there at least 5 years or 59 and a half, whichever is greater.
And that applies to both Roth IRAs as well as the Roth 403B money. Okay.
Should you invest differently compared to being a bi-weekly employee compared to being a monthly salary employee?
And so the question is, should you invest differently depending on your class of employee, right? Bi-weekly or monthly. Let me clarify one thing and then maybe we can jump in. But when you say you invest differently, what are you thinking? Like different types of investments or?
Like how much percentage of money to put in? For example, with me, I'm a full-time employee, but I'm only 30 hours. So should I contribute more or less, or it just matters what your lifestyle like?
Gotcha. So it's going to vary and depends on kind of your goals and what you want to have accomplished. But I will give you kind of a baseline that we discussed actually earlier. So if you're biweekly employee, right? Duke is putting in for a pension benefit. So you're part of the defined benefits plan. But you still want to supplement that income. So at minimum, you should still be saving at least about 3% into the voluntary part of the Duke 403B. You should, at minimum, be doing that, right? But then, we want to think about your time frame and when you want to retire and how much you need, and so that might determine that you should put in more to help offset some of your savings. But at minimum, we would say 3%. Yeah.
One thing I would just add to that too is, typically there's a range, right? And it's actually gone up quite a bit. It used to be 5 to 10% in terms of what we assume people should contribute. That was years ago. Then it was 10 to 15%. Now it's actually closer to 15 to 20% of your pay, right? Which is now, do you guys think that's the average? Is that the average everyone contributes, 15, 20% of their pay? No, right? So it's a stretch goal, right? But it should be everyone's stretch goal. Now, some of that you could argue is combined with contributions that you might get from the employer. If you get a match, or in Duke's case, if you're paid monthly, you get a contribution which can be anywhere from 8.9% up to much higher percentage depending on your salary. But with that said, if you're biweekly, for anyone who's biweekly, because you don't get a contribution into your plan and you are covered by a pension plan after 5 years, if it's something where maybe you leave Duke after 4 years, 4.5 years, you're not entitled to that pension, right? And now if you didn't contribute, if you only contributed maybe 2 or 3% or so, it's not really keeping up with what we're suggesting, right? So it should be something where your target for your own contributions, in my opinion, ignoring if you get employer contributions at all into the plan, for me it's always a target, try to increase it every year. That should be that's a really nice goal, once a year. Increase it by 1%. So if you're at 5% today, try to go to 6 and then 7 next year, and then 8 the next, and then 9 the next. And that makes a huge difference long term, especially because you're a young guy. Yes?
I don't understand the logic of the HR logic of, if you make less than $64,750 a year, which I have actually never made that yet, you get 8.9% of your salary. If you make over $64,750, you get 13.2%. It's like the rich get richer. I don't understand. This is not a thing for success for most of us.
I'm gonna let Catherine handle that.
Let Catherine handle that.
So the new formula has been designed. There's a certain point where when you get the Social Security benefit, you will stop getting a benefit from them. And that's the rate one. That's the 64,750. That's the rate one where you are not getting, more benefit from Social Security. philosophy is to help you replace at least 75% of your income. When you retire, we assume that you will get, say, 75%. So that 13.2 is exactly what he said. It's a gap because you are going to get Social Security benefit, but there's a cap that you can get. So the people that get more than that, there will be a gap for them. So they will not be able to replace the 75% of their income when they retire.
Okay, thank you.
But that's a common question. So-
Any other questions?